Good morning. I'm Julie Hyman with Brad Smith. This is Yahoo Finance Live. Let's get right to the three things you need to know to start off your morning. First thing you need to know, the worst day of the year yet for stocks. All three major averages tumbling by at least 2% yesterday as investors were rattled by a surge in treasury yields and disappointing forecasts from heavyweight retailers. The move in yields was big. For two-year treasuries, it was the highest since July 2007. For the 10-year, the highest since November of last year. As investors await the release of the minutes from the last Fed meeting, markets are now pricing in at least a quarter-point rate hikes for each of the next three meetings. Second thing you need to know, after these big moves in the markets, you're going to get analysis from one of the best-known firms in the investing biz today. And the third thing you need to know, Intel is slashing its dividend. In an effort to conserve cash, the company announced that it is lowering its quarterly dividend by 65% to 50 cents per year. In January, Intel had warned it would lose money in the first quarter as the PC market and data centers continued to take a hit after years of strong growth. The company is committed to cut $3 billion in costs this year. It's targeting $8 to $10 billion in savings by the end of 2025. You call some of these names trash, to put it simply. Do you put AMC and some of those others I mentioned in that category? And how do you think they're going to continue to trade here?
Yeah, it's a good question. I guess that's not very nice, is it? But we do have a more quantitative way of looking at it. We essentially call those names our low quality basket, so this is kind of agnostically sweeping through liquid option names. Who has negative free cash flow? Who has leverage? Who has debt in a rising rate environment? Who has negative net income? And unfortunately, AMC, GameStop, Carvana, all these names that I think everyone became quite familiar with in 2020 when stimulus checks went out. Those were the losers of 2022, but they have really rallied sharply in 2023. But, the fundamentals haven't changed. These are still low quality names facing what is a pretty abrasive environment ahead.
The markets this year, January was okay. We're seeing things really under pressure here. What is causing it, and how much pressure you think is likely to come here in markets?
Well, what we've seen is last year was one that was characterized by the inflation narrative. Obviously, one of the fastest hiking regimes of the Federal Reserve in the last 4 decades or so. And the year started off as just a reversal of everything. And the markets were so pessimistic last year. You got this little bit of a relief rally, but we went a little bit too far, too fast, as we all saw now with hindsight, right? And if you think about January, the bond market was up over 4%. Right, you had stocks that were in the high single digits, right? NASDAQ was in the double digits. In fact, even after yesterday, NASDAQ's still kind of flirting with that double-digit return year to date. And so it's been this big reversal of trends. But what has changed in the last 2.5 weeks is really the market's starting to discount the whole idea of the Fed put again, right? And that they're going to pivot and that we're going to have this, reversion back to these levels of lower interest rates. And so the market's been fighting the Fed, right? The Fed has said they're going to be staunch this year. And all of a sudden now with some of the economic data picking back up in January, right? It was pretty abysmal in December. We saw retail sales come down. You saw the services data come in significantly. And then all of a sudden we get these strong jobs reports. There's a lot of controversy about the adjustments. Now we've seen the inflation narrative again change because of the BLS adjustments, right? So all of a sudden what looked like this glide path that the Fed was achieving, this path back to 2%, all of a sudden with these new revisions, they just add another 100 basis points to CPI. So I think the market is saying all of a sudden they maybe went a little too far, a little bit too fast. But right now, we're really kind of in the rates level we were back in November.
Much more from Brian Sozzi in Tampa, Florida, as we go on throughout the rest of today. But we got to get to one other thing that we're watching here today, and it's kind of yesterday's activity. As yesterday, we saw the major U.S. indices have their worst day of 2023 Tuesday, while Treasury yields surged, adding to investor concerns there. Fed officials will release minutes from its early February meeting later today and give a glimpse of how high interest rates could go here. Now, of course, Julie, as we think about this is backwards looking. This is the meeting minutes for the meeting that took place January 31st through February 1st, and ultimately we got a decision. But since then, we've got even more economic data that's really unveiled continued job gains that we saw in January. Of course, that did lap some kind of seasonal trends that we typically see in a January report, but we also saw inflation slow down less than expected in the most recent CPI reading, and then we're waiting for PCE to still come forward here.
Well, and we've also had a couple of non-voting members of the Fed say they saw reason to raise by 50 basis points, by 0.5%, right? And even though they're not necessarily representative of the whole, they're not representative of the whole, we know, because that's not the decision that the Fed made. But people are going to be looking in the minutes to see if there were any voting members of the Fed maybe who were leaning in that direction. As it is, we're now seeing the market price in 3 more quarter-point hikes at the next 3 meetings. Some people are even looking for 0.5 point increases at one point or another. So that's really what's been spooking the markets over the past few days. We are seeing a bounce back from those levels today, but that could potentially change when we get the minutes out later today if the perception is flipped on its head once again. We've got PCE later this week as well, which could again throw some wrenches into that equation. So there's still a lot of questions about what the Fed's going to do.
Yeah, within that transcript, it'll be interesting to see to what extent there was at that meeting a little bit of Fed fisticuffs, if you will, in terms of the tenor of the discussion that was taking place there and the policy perspective, and to what extent that carries through to that March 21st and 22nd meeting as well. In the meantime, though, in this kind of bounce back that we had seen in some of the more risky assets that were out there in the market, that we had seen in consumer discretionary, XLK as well, in technology even, those have been still up year to date in a sector performance basis. XLY, consumer discretionary, up by about 13% year to date. That's seen a little bit of a pullback over the past few sessions as investors get a little bit more of that inclination to parse through what some of the details were and the Fed speak that had emerged, as well as XLK, technology, seeing a little bit of a pullback in recent sessions too. It's now well positioned to benefit from the growing AI boom. And we're all going to be all over today's call. 5 p.m. Eastern time. Joining us for After the Call this evening, the one and only Dan Halley. Dan, what are you going to be watching for?
Basically, everything you just said. I mean, look, it's a company with, 2 main businesses at this point. They're trying to expand further into automotive, into robotics, professional visual computing, but really it's about that data center. It's about the gaming. And I think, we're going to once again see a disappointing quarter as far as the gaming side of things goes. It's tough to really call it, a complete negative for NVIDIA in that sense, though. Last quarter, we saw a 51% decline year over year in gaming revenue. And the reason for that is the same thing we've been saying about Intel.
Speaking of XLK, speaking of tech, let's talk about Intel. Intel is slashing its quarterly dividend by 50 cents annually as the company looks to conserve cash amid economic headwinds. It's coming after the chipmaker warned of losses to come in the first quarter and pledged to reduce its cost by $3 billion this year. We also, the last time that our Brian Sozzi talked to Pat Gelsinger, the CEO, he said he was committed to the dividend. So it's not, but that said, it's not a huge surprise that we are seeing this move given some of the troubles that Intel has had. If you look at the quarterly basis now, the dividend's going to 12.5 cents per share. It was something like 36.5 cents a share on a quarterly basis.
Yeah, so slashing that by about 2/3 on the dispenses the company talking about. And in a quote in this statement, the CFO, David Zisner of Intel, saying that in the fourth quarter, we also took some of the steps to right-size the organization, rationalize investments. This is on top of what they had already initiated in some of those cost-cutting measures, including the headcount reductions there. It's important to remember what their long-term targets here are on the cost reduction targets, $3 billion in 2023, and then achieving $8 billion to $10 billion by the end of 2025. Also comes at a time where they're spending a lot of money that they've either partnered with the likes of Brookfield, and there's going to be another partner that they've teased as well on bringing some of the capacity up to speed for fabrication processes and foundry services. And so with those dollars, combined with the government dollars that have been earmarked for bringing more chip capacity online, that is where more money is continuing to go out the door for Intel and where some of those costs are being restructured to prioritize what the future of the company and that next leg of growth could perhaps look like.
Yeah.
Hey, Jonathan Pross here. So a lot of people don't know, Driven Brands, you guys run Meineke mufflers, Mako kind of paint and auto body repair stuff, but also you guys are getting into the kind of quick service oil change business, and that's been doing really well for you. How is that offering different than what people kind of see when they kind of go downtown to their regular oil place or a Jiffy Lube, for instance?
Yeah, hi, Praz. Good morning. Good to see you. We have this phenomenal brand called Take 5 Quick Lube. It is a differentiated service model, which is a drive-through, stay-in-your-car 10-minute oil change with a very limited set of menu offerings, which enables us to deliver that 10 minutes or less speed of service. We mentioned in our earnings release this morning that business in Q4 delivered 25% same-store sales. It's now got about 850 locations in North America. We grew unit count by about 20% last year and expect to grow unit count another 20% this year, primarily with franchise locations. So an unbelievable business model that is super convenient, fast, and friendly for our consumers. And then, we're also rebranding our car wash business. We have 400 car wash locations. We're leveraging the success with the Take 5 Quick Lube business, rebranding all of those stores to Take 5 Car Wash. So as you look ahead to the end of 2023, we'll have about 1,400 locations in North America, all trading under the Take 5 brand umbrella. So super excited about both the Quick Lube.
The after effects of the Russian invasion on Ukraine in our markets were, even for me, I think, having been in this particular asset class since '94, were shocking. Basically, Russia was almost immediately taken out of our index. They went from an investment grade story to a non-rated credit. Then people couldn't even invest in Russian credits. And so, they went from trading 200 over to 1,000 plus in almost the blink of an eye. And, had nothing to do with their fundamentals and everything to do with their maybe nation building, if you want to call it that. And not that we would expect the same the same treatment for China, but the Chinese credits that we look at are investment grade rated. They're not yielding a lot. And so for me to have that one thing out there, that could basically blow up your whole investment case, that may or may not come true, but where you're not really getting paid all that much. And how do you even price that? If China invades Taiwan, then what happens to the Chinese credits? So to me, I'd rather not participate at this point.
We've had some downward momentum, at least in those past two candlesticks, from the late 9 a.m. hour into the start of the 10 a.m. hour. We'll keep a close eye on that. Intraday net higher, though, by about 0.1%. Fractional move higher on the NASDAQ as well. You've got some red candlesticks emerging there, too. So we'll continue to watch that. However, still net positive in the S&P 500. Seems like there is a lot of downward pressure that is persisting here, at least right now, within the first and early moments of trade here on the day. We've still got a lot of time left, but minutes to come out from the Fed to get a little bit more insight into exactly how the rest of the members on the FOMC, the Federal Open Market Committee, are thinking and approaching March. Let's also just take a brief look here at what we're watching here. Well, in the NASDAQ composite, we'll just ride out with the view as the NASDAQ 100, the tech heavy average. Julie, I'll talk.